Please visit tradingsim.com to simulate this trading lesson. Hey day traders, this is Al Hill from tradingsim.com. Today we're going to be talking about the art of shorting a double bottom breakdown. Now we didn't want to pull out a clear example because clear is just too easy and the market is never easy. So this example today is going to really dive into some of the complexities associated with a double bottom breakdown. So here you see the first low set at 10:30 a.m. on 6/29/2010 was approximately 24.90 on the low side, and then on 6:30 on the opening gap down, you had a low of 24.84. So these are your two lows. Now here's where it gets tricky, right? You see this next low coming in. Let's forward this a bit. This is where sometimes I think traders get a little confused. So let's help out here a little bit. As you can see, the stock, Starbucks to be exact, on June 30th, looked like it put in another low here, right? And the stock's kind of reacting off of that low. But as you notice, the stock quickly gives it up, right? And is unable to really make the same profound or defined rebound off of the low in terms of price action, right? Because each double bottom, triple bottom, if you will, technically they're going to be, in the same ballpark, but exactly how they go about setting these levels will be unique in each run. So here you have a low of 24.85. So again, you didn't break the low yet, but again, this low here is really not a low per se, right? I mean, it's not really the third low, like triple bottom. All right, so 24.83. So what we can do here, we can say, all right, look, looks good. Looks like it's a go. Let's go ahead and short 10,000 shares. All right, so we're short 10,000 shares at 24.85. You can see that here. Right here, 10,000 shares, short at 24.85, 24.86 rather. So overall value 24.85 when you factor in commissions, because you lose a bit due to commissions. So we fast forward this. As you see this here, the stock really starts to give it up. It's really starting to break through this line here. And the key point here is that you have one low, the second low, right? This here does not qualify as a third low, right? There was no real counter move off of that low. So the good thing is, as a trader, you want to see this. You want to see a stock, right, break through previous lows or come close and try to make a pivot, and it's so weak that it's unable to really get going. This is confirmation to you that the stock is extremely weak. Now another thing, a key thing to point out, is that when you have breaks of certain key support or resistance levels, and these come towards the latter part of the day, odds are traders are now going to force or push that issue into the close, and that's exactly what happens here in Starbucks. So as you see here, traders quickly realize it's 3:30 in the afternoon. No one wants to be stuck holding this bag, so naturally they begin to push the stock lower, and supply enters the market. All right, now the stock is pretty much in a free for all, just slowly dropping down. In this simulated trade, you'd be up approximately $5,000. So at this point, you're going to want to look to get out the position or out of the position, as some day traders are going to look to book profits here. So you're going to want to sell out, or excuse me, buy to cover at market. All right, and we're out approximately $5,000 in profits. So as you see here again, you have one bottom, second bottom. This is not a third bottom, right? Because relative to the other moves off these lows, percentage-wise, it's nowhere near. But that's okay, because instead of a triple bottom break here, you had a double bottom break, which is just as good. And again, this is not bad, right? Because it's a sign of weakness that there was no bounce or counter move strong enough to really get the stock going. So once it rolls, you have pretty much solid confirmation that the stock will move in your direction. Good luck trading.